Hey everyone, it's Imran from Options Insight, your macro options spotlight. So risk assets pulling back pretty hard yesterday as crypto contagion seemed to take hold. We're hearing about Ontario Teachers Pension Plan had a big stake in FTX. We've got BlackRock involved. We've got all these big investors all over the shop getting hurt, writing off millions. It's a bit of a mess out there. China also getting whacked down 4% on the day as COVID continues to flare up. And that wasn't good for oil prices, which were down about 4% as well. So, that whole reopening story taking a bit of a shoeing there for now. I do feel that it will probably reemerge at some point. But right now, risk sentiment seems a bit shaky for obvious reasons. Now, we've got the dollar catching a little bit of a bid, pound getting whacked the most there. But in general, dollar bouncing from its support levels. It's on sort of medium-term trend line. It kind of got down to the bottom end of that trend channel, having a little bounce off there, and a bit of a safe haven bid in terms of what was going on in crypto, coming back to the dollar, and bonds also steadying a bit ahead of this CPI data, and midterms as well proving to be closer than what we first thought, making the Georgia runoffs in December more important. In terms of the implied vol, it's hard not to be a bit nervous watching the price action in cryptos where some of these tokens are dropping by 50, 60%. So clearly vols in general finding a bit of a bid. See up about best part of a vol there across stocks, and also seeing HYG up over a vol point there as well. We have got CPI today. That's pricing in about 2% move on the S&P. And we suspect this is probably going to be the low end of what actually transpires in terms of the move. So last week's events were priced closer to sort of 1.5%. CPI's got a little bit of a premium on top of that. And so we'll see how that plays out. That's actually going to come out pretty soon. In terms of carry, we are seeing bonds still remains to be the best place to earn carry right now. But I suspect bonds are going to have a bit of a move on the CPI. So not really rushing out to sell gamma there ahead of the number. European stocks still remain in the green, and then everything else is pretty much in red. Obviously, FX gamma has been working well, with the pound being the best one still. And we do believe that the pound gamma is going to hold up because they've got that big event next week in terms of the fiscal package being announced. So we do not think these vols that are currently parked at 13 odd are going to just crater after the CPI, whereas you might see a bit of a drift lower in euro vols and dollar yen vols. We think sterling vols are probably going to hold their value a bit better. If we look at skew, we see equity skew on its knees across the board. It did bounce, obviously, a little bit as this crypto contagion is kind of these fears about crypto contagion are escalating. So it would make sense to see a bit of terrorist buying coming out on the back of that. We also see, in general, with these low skew levels that we're seeing in HYG and in equities, we kind of think it's probably better to own the stuff that is on a lower absolute level of vol. So that is things like Europe, which is about 4 vol points lower than S&P right now. And then HYG, which is another 5 vol points below that at 15 vols. And the reason we say that is because if you're going to buy a load of skew to the downside for a potential crash, you want to own the stuff where the implied vol has got a lot of upside, right? It can go up by a lot. And when you've got S&P vols already at 25, and we've seen on the way down, S&P vols are struggling to really break above 30. They don't have as much room to actually explode. So that's why you potentially want to own skew in things which have a lower base vol, so that vol can really pick up if the market does suddenly start to move. Okay. Anyway, that's the summary for today. All right, looking forward, what are we seeing? So looking beyond the crypto massacre over the last few days, obviously CPI is going to be the focus for today. It's expected to cool down a bit. We've seen obviously much lower used car prices and commodity prices have been coming off. On the flip side, shelter and rent have been sticky, and that's expected to continue to go higher. So the market whisper seems to be for inflation to come in below expectations. And with so many calling for a year-end squeeze, we feel that the risk is slightly skewed to the downside in markets if we were to get an upside surprise print in terms of inflation. So that's kind of where we think the setup is. Outside of today's print, we think broad macro fundamentals are deteriorating. We've got net liquidity, which, you can look at that via the Fed balance sheet and the TGA account and reverse repo. Based on what we're seeing going into year end for the Fed balance sheet reduction and the plans for the TGA, that is set to fall quite sharply. So you can see on this model, that is free and available on Twitter. This model is suggesting that fair value for the S&P is closer to 3,400 based on net liquidity dynamics between now and the end of the year. So that's just something to be aware of, and will probably be a bit of a headwind for the S&P to really get into any type of year-end rally. You also got the chart on the right. We've got equity risk premium is at GFC lows going back to 2008. So similar sort of levels here. So what is that? That's the earnings yield versus the 10-year bond yield in the US. The fact that that's so low is basically saying that you're not getting any extra yield to take on the risk of equities, right? And given the amount of wealth destruction that we've just seen in the last week in crypto markets, there may be a reason for some flight to safety out of stocks and into bonds when we're seeing such a low equity risk premium. So something to be aware of there, and maybe why equities might struggle in coming weeks and months. All right, now if we look at VIX, is it waking up? So since the FOMC last week, we have seen VIX steadily trading lower. So that's the green line on this chart. You know, even though the S&P, which is the yellow line, came down since the FOMC, we've seen VIX lower as well. So VIX went from highs of around 27.5 down to a 24 handle. And then S&P kind of popped its head, obviously, initially on the FOMC up to 3,900, and then it went on to sell off down to 3,700, right? And the VIX just couldn't catch a bid on the back of that. Now, suddenly, over the last sort of 48 hours, as S&P has had a move from around 38.60 down to about 100 points lower, suddenly VIX has started to go up, okay? And I think this is, again, because of this risk of contagion and the worry that if you start getting mass liquidations out of crypto, because there are a certain amount of institutional investors who are in that space, they may be forced to reduce risk and cut books in other asset classes as well. And so the VIX is catching a bit of a bid on the back of that. Okay. Obviously, you know, we've been looking at VIX, we've been looking at VVIX all year to try and find some signal there. We do think if CPI comes in hot, there could be room for the VIX to pop a bit more. Because markets just do look like they're a bit vulnerable right now that the midterm election optimism seems to have passed. It's hard to really see what's going to make this market go up significantly in the super short term. Obviously, you've still got that underlying bid from corporate buybacks. You've got that kind of argument about CTAs buying as well. But apparently some data out there I saw said that CTAs have kind of covered a lot of their underweights anyway. So maybe there isn't as much buying flow there still to be done. So in terms of trade ideas on the back of, if you do want to buy the VIX, what could you do? In today's daily note, we also mentioned the dollar parked sitting just above some uptrend support. Obviously, CPI is going to be a big driver of what the dollar does next. We personally do not think the dollar trend is broken yet. DXY below 108, we would reassess. It's a big support level around that area at 108. But in general, we think the structural reasons why the dollar is going to continue higher haven't gone away. So if anything, we're going to be looking for ways to kind of add to dollar longs if we do get that type of move post CPI. All right, that's it for me today. Thanks a lot, everyone, for listening, and I'll catch you all tomorrow.